Can the feds actually save our real estate market here in Southwest Florida? We're going to dive into that. The news out there is that the feds are getting ready to do a round of interest rate cuts by the end of 2025, maybe even as much as 100 basis points, which is a full percent. What will that do to our market? That's what this is all about. My name's Ed Zoller. I'm a real estate agent over 25 years. I've been doing these market updates monthly and continuously and religiously for you guys. I do apologize. This coming out a little later than the first of the month because I was on a cruise. I just got back and wanted to shoot this video, get it out to all of you. But I did write this update previously and wanted to get this out. So let's go to supply and demand and dissect this a bit. So inventory. Something to take note, our inventory went down. That's good, 6.1% down again. I mean, the month before that, it went down 6% as well. It tends to always go down in June. As you can see from the previous graphs, this peak here is March. So after March, you got April, May, June, all the way to September. Each bottom is September. So what do I think this is going to be? I think this is going to be September as well. We're going to see a bottom and probably the lowest inventory, but look how much higher we're starting out. When we start out at 11,000 homes, we go down to 8. When we start at 10, we go down to close to 7. Or 10 here went down to 7. About a 3,000 home swing on the up and down. And this way overshot for 2025. And even if we come down another 3 months, and let's say we go down another 6% each of those months, we're still going to be around 10,000 things for sale. And what happens after September? It goes up $3,000. So we might go right back up to 13,000 homes again. That will be a little lower than this, but we'll have to see. We don't know what is going on with that. Either way, 800 homes disappeared from the market. That's a good thing, but they didn't sell. And so last month I started in a new graph. Where did they go? Well, we're going to get to that. Same as we did last month. But I did want to let you know of the 12,208 things for sale, that 2,100 of them are new construction. That really hasn't moved. 63% of them are single-family homes, 28% are condos, and the rest are townhomes and villas. But where did 700 homes go? Didn't we have 13,000 last month? We did. So where'd they go? Same place they went last month when we lost 800 homes. They got withdrawn, expired, or just taken off the market and terminated. I discussed last month's video the differences between the three, but just they all have the same results. They were on the market, they wanted to sell, and they took themselves off the market one way, shape, or form. It's what the market needs. All of these homes are mostly overpriced, upside down, or unrealistic sellers who still think it's 2022 and they can sell their house to some investor for 5 times value. And that's just not happening anymore. So we're losing a lot, 2,256 homes. If I told you that last month was the record by far, we never even hit 1,500 in a month. We hit 2,261. So I guess you could say the positive is it's a little less, like 10 less, but that's a huge amount of homes to have withdrawn, expired, or terminated in any given month at all. But obviously, our inventory didn't go down 2,200 homes, so we still gained inventory. We still have homes that are being put up for sale that's still offsetting this, but not all of that. So maybe 1,500 homes came on, 2,200 expired, withdrawn, terminated. We had some that sold, but we'll get to the sales right now. Demand. Okay, the peaks. All March. Look at how progressively every single March they're just getting lower and lower and lower. And look at how pathetic this March was. Didn't even hit the trend line I tried to draw, where just to kind of see any kind of trend that this market's doing. And look at how each high was lower, lower high, lower high, lower high, and then the lows. Going all the way back to COVID, the lower low, lower low, lower low, lower low. This is buyers. This is buyers wanting to buy homes. January was the worst January in 40 years. We never sold as little in 40 years than we did in January. And it's been true to every single month. The worst February, the worst March, the worst April, and now the worst May and June in 40 years. All happening in 2025. So sales did go down 6%. We expected that because last month the pendings went down about that. So in pending sales, that's a house coming off the market because it went under contract. When that goes down, you expect the sales to go down. We'll get to that in a few graphs from now. But why are we just losing buyers left and right? We discussed that a couple videos ago, as well as last month's video about the population decrease. But we are definitely seeing a huge slowdown of buyers as expected for June, but really, really bad for this year. And that's because interest rates, even though they've gone down from 6.97 to 6.72, still too high, still unaffordable. and we'll get to that. Average home price actually went up. And what I wanted to show you with this graph is when you have very low sales, and I'm talking, what was it, that graph, 1,100 sales, and 90 of them, 10% or so, a little less than 10% of them, sold for $1 million plus, and one of them sold for $8.65 million in Bonita, that's going to skew this median home sale price in Lee County. But I've been consistent with this graph from day one, all the way back to when I started building it. Probably 2001, had to backdate some of this stuff. But this is showing a couple things. One, as long as I'm consistent with it, you'll see a trend. And what was this trend here? This is a trend going down. Ever since 2022, the price has been coming down significantly, especially when it topped over 400,000, and now we're at 367. Is this the real price of the median home? No. This is skewed because we have a whole lot of $1 million homes that are still selling. People buying $1 million homes usually don't need an interest rate. They don't leverage their money. They pay cash. So interest rates are not impacting that market as well as it is the regular real estate market. Where do I think market should be? That's what this graph is. How this graph is made is I take the average median household income and I take what houses would be affordable at the affordability rate of 26% of gross income. And you can see here, it's a nice flat line. As income goes up, so do house prices. Makes sense, right? And you can see here, we almost, when we overshot it during this bubble, we overcorrected on the downside and we got back on track. And from 2016 all the way to 2021, we were just doing exactly what the market should have done. As income went up, so did home prices. And then what happened? Well, if that's a bubble, what the heck is this? That's a bigger bubble. And what's probably going to happen is the same thing. I say history repeats itself. If you believe in that, then we're going to get past this track, go under it, and come pop back up again, get back on track, and everything will be great for about 10 years. But for right now, we're way above that mark right there. So just something to consider as we watch this graph. You're going to see this fluctuate up and down a lot. But overall, if I look at month to month or quarter to quarter or half year to half year, the trend is it's going to go from this 400,000 mark, and in my opinion, needs to make its way towards that 250 mark. Anyway, that's that. Let's talk about affordability. This is in my opinion, my top two graphs to watch. If you want to know what the real estate market is doing, just look at this. This takes into effect mortgage payments, which is your property taxes, insurance, interest rates, and the average home price for the month, and divides it by the median household income for the county. And so what you can see here, all the way since 2005, is this sustainable when you're above this line? Can someone afford more than half of their gross income to rent or a mortgage? No, it's not sustainable. It's not affordable at all. And so what happens? It corrects itself. It goes under the line where it should be, and it kind of hovers around this 20, 21, 22%. Makes sense, right? 1/5 of your gross income going towards a mortgage, which means you probably need 1/5 of that for taxes, and you live off the rest of it. So this is why this is kind of like a snapshot to say, as we keep track of household income, which went down a tick, $50, not a big deal. But Census Bureau does come out with this every single month. We can actually reverse math this stuff. Yeah, we're at 38.2%, which is better than 48, better than last crash, which was 52 to 40s. But look what happened back then. It went to the 30s and it went to the 20s and very rapidly got down to affordable again. We are not going very fast this time around. The interest rates did drop, but the median home price went up. And then the income went down a tick. And so all of this is kind of, it's all putting it into one picture. What do I think mortgages should be? Well, I think mortgages should be about 22% of this number. Divided by 12 is about $17.27 a month. That's where mortgages should be. But if I add up all the houses right now, it's about $23.77. That's 38% overinflated. Does that mean prices go down 38%? Well, it would fix things if they did, but it's going to be a combination between the property taxes, insurance, interest rates, and the price. All of it making a monthly payment for people to make it affordable. We are not getting any closer to this line. I mean, it going from 38.3 to 38.2, it's going to take a long time. We need to see this number go down fast if we're going to see any kind of stabilization and affordability happen here. And then stabilization. The Zillow Home Value Index, although Zillow, a lot of people hate the data. I love the data because they're great data. They might not be accurate with some of their things when they're trying to practice real estate or even have mortgages and try to estimate your payments, or that Zestimate, what a joke. But they do keep good data. And something that I found very, very valuable is, when do we stabilize? Back in 2000, all the way to the boom. Obviously, we were going way too fast, too quick, way past this zero line. 0% means that the house price didn't do anything that month. It just stayed the same. Well, that doesn't really happen. Actually, you can't even show a time where it flatlined that way. We were just going up, 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 up. And obviously, when we're going up 3% a month, 2% a month, multiplied by 12. That's how much price action we were getting. Obviously, that was a bubble. Then, as we were losing up to negative 3% a month or negative 36%, and it stayed down here a lot longer and it stayed up here, then we were starting to correct. As it gets back to stabilization, it kind of back tested, it kind of rejected that line, came back up, rejected that line, came back up, and then showed stability right about that 0 to 0.5% mark. And from there, kind of just stayed stable. Isn't it funny that we keep looking at these graphs and we see how 2012 was kind of like a stabilization mark and the beginning of it, and then we got back on track about right here, about 2014, and then all these years, it just kind of stayed between 1% and 0. But then COVID happened, and then boom, look at that, 3%. Each dot is a month, and the lowest we ever had during COVID is still over 2% a month. And then we went back again, almost to the 3.5% mark. And then now we're on our downward trend. This is the trend you want to look at. Here's the previous months. 59 consecutive months was the last crash. And we are at 23 consecutive months now. But look at how it's getting further and further away from stable, just like it did here. The last time we were negative 1.22. We broke the 1% mark last month. This month we even went further past the negative 1% a month mark. We have to go back to February 2007, which was here, when it was still going way down, or we have to go back to October 2009, but it was on its uptrend. It already hit a bottom and was starting to rebound again. What are we at now? We haven't hit a bottom. So I guess we're going to look at history and say that we're kind of right here. And where do I think it's going to go? I think it's going to get further and further away. Hope not, but things have to happen, and something has to show something that's going to reverse this trend. But this is what trends are. You look at the trend and say, what do I think it's going to do next month? Real easy. We're going to get less stable. So let's compare month to month. June 1st to July 1st, our inventory went down. We saw that, -6%. We lost about 800 homes. The single family sold actually went down 6% as well. So again, the lowest June sales in 40 years is 1,164. Total pending sales also went down 11%. That's a big number. When you think of pending sales, 1,700 pending sales in June equaled 1,100 sales. So what's 1,500 going to equal what? Do I expect it to be 1,100 sales? No, probably not. If pendings are down 11%, I would say you take this number, probably get down to the 1,000 range, which would make the July, that would be the worst July in 40 years. New construction didn't really make a ding. I mean, they had a couple of them disappear. Matter of fact, I did look up. A lot of the new constructions you see built by these mom and pops are going into foreclosure. And some of them are already gotten foreclosed on, that they've been sitting there for a couple of years. These are all speculation investors who built a home thinking people are just going to gobble it up. They're not even from here usually. They're from out of state, and they buy a lot and they start putting up a home, and there's no buyers for it. They cannot fund the holding of that house like the big ones can, like your Lennar, Adams, Pulte, the big, huge builders out there. Average time on market stayed the same. As you saw, the median asking price did uptick a little bit. The median selling price did go up as well. But people aren't getting as much for their asking price as what we've been seeing, a stabilization of about 6% off for this month, although it's low sales again, 92%. And I did see a couple of those $1 million homes that sold for like $1 million. The asking price was like 1.5. So that's also going to skew this number a little bit. But overall, when I ask a seller, hey, what do you want for your house? Because we're going to have to pad it because no one's going to give you full price. Matter of fact, the average person takes 6% off, which means more than 50% take more than that, and less go higher than that. So either way, that's just data to keep track of. Buyer's market, obviously, all the way. I'm going to stop doing this graph because obviously we have a ridiculous amount of inventory. As soon as you see 5 figures, 10,000, 11,000, we're not even going to think about even chewing this up in a year time unless we keep losing 2,000 homes from expireds and terminateds. That will change. But either way, we're not into that really crazy 18-month supply range like we were back in February. But we are hovering right in this what I call super crazy buyer's market. And we're going to stay between super, wicked, and extreme probably. But either way, that's just what this shows you is how many months of inventory we have if demand keeps at the pace and the inventory keeps at its pace. Price cuts is kind of interesting. So in June, Lee County, this number shows you for just Lee County, how many total of the total listings. We got 12,000 of them, right? Much percentage of them dropped their price in the month of June? And you can see here that we were 32%. Now we're down to 27.7. Now we're still way above our long-term average of about 23% of all houses dropping. But there is a trend I want you to see here. Look at the peaks. Don't they look, except for COVID, don't they look about 1 year apart? Like that's 1 year apart, and that's 1 year apart, and then that's COVID, and then that's 1 year apart, 1 year apart, 1 year apart. We had to have the most price cuts when we have the most inventory. So the fact that we're losing inventory makes sense that we'd be dropping in price cuts. Are we the only ones experiencing this kind of positive news in Florida? No. Tampa is still leading it right now. And I remember, God, this had to be a couple of years ago, that agents in Tampa were like, what's going on with you guys down there? We're still rocking and rolling. We're this huge, crazy seller's market. Oh my God, your price cuts and your inventory growth. And I'm like, give it time. Florida kind of goes in, not every part of Florida does the same thing at the same time. We kind of led the league. So did Northport and Punta Gorda. They're still not above 30%, but at least we're not number 1, number 3, or last month, number 8. We've dropped down to number 14. So Lee County ranks 14th among all the counties in Florida with the most price drops. So this is actually a positive news, but look at how bad Tampa and Jacksonville are going right now. I always say the Villages is kind of small. So is Homosassa Springs. But when you start getting over 500,000 population, like in Palm Bay, Daytona, close Ocala, Northport, obviously Orlando, huge. 30%, there's 2.8 million people there, and 30% of their listings are dropping every single month. 27% is way higher than our average, so it's not good, but which is positive news, is we're not number 1, 3, or 8 like we were in the past few months. So let's talk about what's the new news out there is everyone's talking about the speculation that the Feds are going to cut rates in 2025, 3 or 4 quarter point cuts. So will that help us? If they do 4, that's 100 basis points. A basis point is like a 0.01, right? So if you want 1% off of interest rates, or what is really the Fed rate, then that's 100 basis points is what we call it. Instead of 1%, we say 100 basis points. Will that ignite our market? Well, interest rates in the past have not been that silver bullet we're all waiting for. Lower interest rates can reduce borrowing costs and stimulate buyer demand. That's what it does. It also stimulates banks from borrowing money from other banks and then lending them out to other banks for more mortgages. And this is what would make mortgage people really happy. More loans, more buyers, right? All kind of combined together. But it can backfire too. End of 2024, just last year, we had 2 Fed rate cuts, which increased the mortgage rates. Both cuts led to 2 increases. Why is that? Because we were still battling inflation. They cut the rates and they really didn't earn it. And so mortgage rates are not just the Fed rate. The index rate is also margin. And at the time, margin, which is risk, it was a riskier market. So even though they dropped the index part of the Fed rate, the mortgage itself went up because people were starting to go into foreclosure. People were starting to be 90 days late on their credit cards. This is what makes a mortgage rate. This is why when the banks can borrow money from other banks at 4% and they're paying you a CD at 4% or something like that, well, their mortgages are going to be higher. So there's a margin in that, an assessment of risk that loan would not get paid that banks are going to make, and that's how they stay in business. They pay you 4, they take your money, and they lend it out at 7. And they pay 4 for it. So will this happen this time? This current real estate bubble was driven by disappearing inventory from COVID. That's what started it. Mixed with the investor overexposure. I had an update a long time ago that talked about we had more investors buying homes in 2023 than any time in our county's history, even back when we were the foreclosureville, and you can buy 10 for 1 on the bad loan years during the bubble, and you could buy houses for $60,000 and rent them out for $900 a month. We had more investors buy when the houses were 400 grand than they were when they're 80 grand. And we had stagnant wage growth as well, kind of stayed the same. So when you take all this, can interest rates fix this? No. So a few rate cuts are not going to cure this real estate economy. Historically, it hasn't happened before. It only will delay the inevitable correction rather than fix it. And so this is why I'm not a fan of interest rates going down prematurely. Go down because we fought inflation, maybe because the economy is getting better or wage growth is there. Then lower the rate. But all this is going to do is, do you think prices are just going to start going up after this? No, they're going to continue to go down. If the rate goes down, it's going to get us to that place we want to be. But we still need prices to come down as well. So I did the math because most people don't like to do math. What's a 1 full percentage off the rate? What would it do to our real estate market if it happened today? Well, let's look at it. 100 base points. Average home price right now, $367. Interest rate current, 6.75. Average household income current right now, $74,000. Home payments, $2,357 compared to household income is 38%. We know from the last graph that that's not sustainable, that's not affordable, and it can't work. So let's drop that interest rate to 5.75 from 6.75 if the feds cut the rate a point and if the mortgage rate also goes down by that point. Then using the same figures, this changes the monthly payment to $2,167. That's 35% of someone's household income, gross income. Is that sustainable? Has that ever been sustainable? No. So great, it gets us 3 points closer, but don't we need to be at like 21, 22? So it's still not going to stop the prices. So I did this. This is where 35 is on this graph. This is our long-term average. Of course, we have a lot of booms that kind of made that a little higher. You can see that most of the time since, go back to 2009 all the way to 2022, it never hit that level. But let's say that level is sustainable. This is where a Fed rate cut of 1 point is going to take us, this red line. And what happened historically since 2005 when the number hit this red line? Well, on the way down, it still went all the way down. And what's it going to do? And when it was going up during COVID, it went way high. So what's it going to do now? Needs to break that red line. And again, needs to come back down. And I drew this green box. This is where I believe things will become affordable again. This is when the buyers come back. This is when the population starts going up. And this is when real estate stabilizes. When is that going to happen? Well, the way this graph's going, it's going to take a long time. But doing some math, I just want to show you this. To bring it down to this box without rate cuts, the price alone would have to come down 35%, which means 367 median needs to go down to 238 median. With the rate cuts, it still needs to come down to 260 or come down 28%. So the rate cuts will stop the prices from bleeding out 35%. It's still going to go down 28 unless we can get some more interest rate cuts from that. So just want to show you, will the rate cuts do anything right now? Will it cure our bubble? Will it cure our crisis of affordability? No, it's still going to make it unsustainable and unaffordable. And we want to get to this green box right here. So that's my insight using data and graphs about the Fed rate. So let's do an overview real quick. And I've already gone over this stuff, so I'll just kind of let you kind of either pause and read this at your own. But obviously pending sales went down, showing sales dropped. Median home price went up, but again, we had 100 plus, 100 homes or so at $1 million range. New construction still running the show, absolutely. Builders are still continuing to offer 4 and 3% interest rates so that they can keep their prices higher. The monthly payments dramatically lower because they can make an interest rate that doesn't even exist. But it still has to make sense. You still have to make it affordable for yourself. If you can only afford $1,700 and say, Ed, I'm the average guy, I'm the average household, we're making 77 grand a year, and I want the average home, you will be able to buy it. Every year you've been able to buy it, except for 4 years, 2 years of bubble 05, 06, and 2 years from COVID. And drawing into our third year now, but we are in our correction mode right now. Home value growth, again, we've broken that stabilization line. We're past that negative 1% per month dropping in price, and now we're at 23 consecutive months. If we were exactly like the last bubble, 59 is the number. But don't see the same factors of it lasting as long. So I think it's more going to be like maybe another year, and then we might see where it's not going down anymore. My advice for buyers is the same as last month, which is the same month before that. Patience, 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 patience. Wait your time. Falling dagger markets you should not reach. You'll get cut. You let the thing turn to a feather and fall into your hand. You wait for your deal and you do not settle. You want a house that you're going to love right now. And if you don't love it, then you don't get it. You got to say to me, I love it. And I'm going to tell you what's wrong with the house. You're going to say, I still love it. I'm going to tell you how much it's going to cost you, how much money down. You're going to say, I still love it. Then you're going to be in that house probably 7 to 10 years. And will it matter whether you time the market perfectly? Well, if we get these great interest rates and incentives, $100,000 of incentives, or like my friend Dave, who got $250,000 worth of incentives or whatnot, if we make the deal happen, and you have a monthly payment you can live with, then it doesn't matter if the prices even go down because you love the house. It's not going to play any factor until about 7 to 10 years from now. And by then, all this has kind of rectified itself. I tell the people my story. I bought my house and it lost $60,000 in 8 months from me buying it. I didn't quite time it right. And I look at the market every day and I do these graphs every day. But I didn't need to time it right because I love that house. I'm still in that house. 17 years later, I'm still in that same house because I loved it then. Doesn't mean you're going to be in the house for 17 years because you love it. But if you just like it or say it'll do, or man, I need a house because my lease is up and that'll do. No, don't buy that home. So I do still believe our home prices are 18% overvalued. I think the interest rates are going to come into line. I think our taxes come November, you'll see them go down, and our insurance will be lower because we're gaining more and more companies. And all of this will help us get back to that $1,700, $1,800 a month that you want, as long as you want the average home in the average location. Sellers, season's over, and you ain't coming back till January or February. So if you ever thought about selling your home this whole year, time to cash out now because you're only going to keep losing this fake equity you gained from COVID. You are competing with builders. I don't care if you put a new fence on, got maybe a pool because builders aren't doing that, but you just have to price yourself according to the market and stay ahead of it. This is why I do these updates for my sellers as well. So if I know that the market went down 6%, we're doing price cuts to stay ahead of the market, not wait a month or 3 months. I'm calling them weekly and letting them know, hey, if we haven't sold your home, and I am selling my homes, just some of them taking a little bit longer because maybe it's not like we're guessing. It's just we got to get to that price point that's going to make sense for buyers. And you do have to market your home differently because when you're 1 out of 12,000, MLS ain't going to do it for you, and neither is Zillow. Open houses are currently still working thanks to the NAR lawsuit that happened 2 years ago, and something that we do on a frequent basis when there's traffic and activity. But when we have record low sales and a slow summer, open houses, why have a sale when there's no one in the store? You got to get people in the store, and then you have your sale, and then you can sell stuff. But and just for those out there, it's like, Ed, we bought our home for $400,000. You're now saying our house is worth $300,000. What do? We want out. You can do this without spending a dime. I've done 3 of them last year. I did 2 year this loan. I'm working on 1 more right now. Or you pay nothing. You get out from under your home. If you're that upside down, don't wait 17 more years to get your price that you were waiting for that you could have gotten 2 years ago. You may have to wait 17 years. If it was the last crash, you waited that long, and eventually you did get your price. But if you're not going to stay in that house and you're going to be miserable in that thing, why wait till it bottoms? And then what? You think it's going to go up right away? So there is way out of this if you are in that dilemma. And then obviously the data that I pull to make my graphs and everything else. And guys, you call me with anything. You're watching this, you're not even in Florida and want me to look at your part of the United States. I can do that. Most of these graphs, the data I get, these sources, I can pull up any state, city, county, metro area, even zip code, and pull up the same thing. Won't be as detailed as self-before because I'm not in your market every day, but it'll be pretty close to that. And then, of course, if you're a buyer out there with your patience and don't mind going through the steps, you can go to teacherscanbuyhomes.com, that website right here, and you fill out a 3-minute survey. It'll send your information to me, and I can get you started. Even if you're not a teacher, it's a format that I have right now with the Teachers Can Buy Homes site. Lee County Market Update is where you'll see the PowerPoint. If you want to watch this PowerPoint and read along, because obviously I'm not reading it verbatim to you, you can put that's more of my insight. Or the best way, just call me, 239-980-2792. That's my cell phone. It's on me all the time. I'll pick up the phone, or if I'm with somebody, I'll call you as soon as I'm not. And if you have any questions about anything, give me a call. I would love to hear your own concerns. And thank you so much for watching. So hit that subscribe button if you want to see this go out every month. And it will go out the first of every month, but I was away this year. This is my one-time trip. Usually the week of July 4th, it just happened I was out before the 1st. So anyway, thank